My name is Sam Levitt. I'm the ESG product lead at Amenity Analytics. I'm joined by Doug Hopkins, our head of business development, and Tom Endine on our model development team. So without further ado, I'll let you take it away, Doug.
Great, thanks, Sam. We'd like to thank everybody for joining the webinar today. Is there alpha in ESG? The saying goes, there's no I in team. And it's also been said that there's no A in ESG. However, spoiler alert for today's seminar, there is alpha in ESG. And I think as more data emerges and more history develops, ESG will continue to be a driving force in investment decisions. To give a little context to Tom's presentation today on alpha in ESG, we thought we would go over how we're arriving at the data set. Amenity started 6 years ago, and with a little bit different approach to NLP. Amenity decided to do contextual NLP, and a big part of that contextual NLP is for any data set, whether it's transcripts or ESG news, is to develop key drivers. And here are our key drivers for ESG. And then behind those key drivers, we build taxonomy. So for example, you can see that ESG is a very wide topic, and our taxonomy can go into the thousands. So on any topic within ESG, we build subtopics, and those subtopics branch out. And we score each one of these, and each one of them rolls up to the main topic. And that data is the basis for what Tom has built the paper on. So with that context behind us, Tom, take us away. I'll pass over the screen.
Yep. And real quickly before you get started, Tom, I just want to say, if any of our viewers have questions, please feel free to leave them in the chat, and we'll get to them as they come up.
Awesome. Thanks, Sam. Thank you for the introduction, Doug. Just want to confirm everyone can see the right screen, right? Awesome. Yeah, so like Doug said, the motivation for this project is kind of all the explosion of interest that both retail investors and institutional investors have had in ESG. There seems to be a misconception out there that you can't really use ESG issues as a strong trading foundation beyond some of the other fundamental issues that are typically traded upon. First, I want to review some of the literature that was out there. Queen and Doherty in 2020 found that ESG controversies lead to a kind of a V-shaped stock price movement, a quick sell-off when an ESG scandal first surfaces, and then also an equally quick return to the norm. They found that the market tends to overreact to these scandals. Ubai in 2021 wanted to see if he could find this same sort of pattern by using 6-month ESG news sentiment, rolling ESG news sentiment. And there at ERP, they found that the most negative ESG news sentiment companies over the rolling 6-month scores outperformed the market, and the more positive companies. So for an idea of kind of what this would look like, we have our own data. We have the extractions by positive and negative polarity on just a raw count here, and we have the stock price. I wanted to use Walmart as the first example of these V-shaped recoveries. You can see the first big news event here with around 1,000 extractions, 1,000 negative extractions, and a good chunk of positive extractions would be for Walmart. That would be the anti-bribery case that they settled in mid-2019. We capture that with our legal regulatory event within our taxonomy as a positive for the settlement and a negative for the bribery case itself within our ethics anti-corruption taxonomy. We see that there was a big sell-off as Queen and Doherty found before, and then an equally quick recovery. In early 2021, they were accused of violating the Controlled Substances Act with their policies towards opioid prescriptions. We see another big sell-off here, and going towards the end of the data set that was used, we see a recovery as well after this big negative polarity boost. So for the next example, for General Motors, and this isn't to say we don't have any data here, we just, if you look at the scale, this was a very widely talked about issue. They had, and this was captured by our human capital event, they had the UAW auto workers strike, which led to a big sell-off and then later a big recovery as well. This was heavily talked about and led to the stock price collapse here, and then also the rebound afterwards. So our backtesting methodology, of course, being heavily influenced by the literature out there, we sought to seek whether we could use shorter term, shorter than the 6-month period that was used previously, to find perhaps a shorter time horizon that could be utilized for trading. The 6-month time, the running 6-month time period covers 2 earnings calls. There's a lot of data out there that can happen within 6 months. We wanted to look at weekly scores, monthly scores, and quarterly scores. We also wanted to see if our environmental scores, social scores, or governance scores split out could potentially have more signal than the ESG score combined. We wanted to see if one of those 3 umbrella topics had more of an impact than the total ESG score. And then also expanded upon Blanchard and Petit in 2017. We wanted to, separate from some of the existing literature, correct our ESG news scores for the actual context and industry. For example, in the oil and gas sector, a sector that's always going to have an inherent kind of negative slant towards their ESG, we wanted to have our scores factor in that context, so you don't have just an ExxonMobil being compared against an Amazon when Amazon doesn't have the same exposure to environmental risks that ExxonMobil does. We also wanted to copy or expand upon the previous methodology using quintiles and take these scores that were corrected for industry context, put them into quintiles from the most positive ESG sentiment to the most negative ESG sentiment, and see how the top and bottom quintiles performed relative to the market over different time horizons. So kind of to show some examples of what this industry contextual scoring will look like, we have first our examples of our most negative companies. So we have PG&E, which of course shouldn't be no shocker with different environmental scandals that they've had, also their bankruptcy fairly recently. With Walmart, I just went through that example with the anti-bribery and the opioids issues. Dominion Energy, similar issues to PG&E, and then Target and Equifax with their large data breaches helped put them in this pit of some of the more negative companies. For the more positive companies, we can see kind of a few different things going on. For General Electric, which is our most positive company here, or one of our most positive companies here, they're lifted in large part by the fact that the rest of the industrial conglomerates GICS industry has done very poorly. Some of their biggest peers in that field being Honeywell and 3M, which have had a litany of ESG issues that have made their score a bit lower than typical scores and lifted General Electric in comparison. We also have Amazon, Comcast, Walt Disney Company, and Pepsi. And these could all be, but especially Amazon, could be an example of greenwashing, which Doug will get into later, which is another field that Amenity has been working in. So with that said, I wanted to show kind of the first results of just taking the simple quintiles over the weekly, monthly, and quarterly periods and seeing how the different quintiles performed relative to the market. So here we have the adjusted return relative to the market, and we see that on for weekly scores, there's a modest over and under out and underperformance, which follows the most positive companies outperforming and the most negative companies underperforming. But the magnitude is very small. This is just a slight over and underperformance. On the monthly and quarterly side, we do see a lot bigger of a magnitude here. We see that the most positive ESG companies outperform and the most negative companies underperform in both the monthly and quarterly periods in the same period where this news is coming out. So there's no lag here. So this captures kind of the downswing of that V-shaped stock price movement. The most negative companies that might have a scandal come out within that month and within that quarter are going to underperform. Next, we wanted to see if we could catch the upswing. So here we have those same quintiles from time period T, and we look at how they perform in period T plus 1. So we see that there's a bit of a mean reversion on a weekly period, but again, the magnitude is very small. No discernible pattern on a monthly period, but then there is an outperformance or a reversion to the mean relative to the market here for the most negative companies the next period, the next quarter, and another reversion to the mean in a negative direction for the more positive companies the next quarter. So this captures the upswing of the V curve for these more negative companies. Next, we wanted to break out the scores from total ESG to the environmental scores, social scores, and governance scores. And you'll see that only out of the total data set that was originally around 1,200 companies that had enough news to be scored, only about 412 had enough environmental news that came out to allow them to be scored. So it seems that just looking at environmental, there's not as much news that comes out for these environmental issues versus some of the other topics. We see that there's, again, very tiny magnitude outperformance and underperformance for the top and bottom quintile, no discernible pattern on the monthly time horizon, and then again, a very slight outperformance of the negative quintile and overperformance of the positive quintile on a quarterly time horizon. So there doesn't seem to be really any discernible pattern for all three time horizons. Moving on to the social scores, which would cover kind of different diversity and inclusion issues, workplace safety issues, stuff like that. These also seem to have no discernible pattern on a weekly, monthly, or quarterly basis. Weekly, you can barely see that red bar right there, but the magnitude is tiny. Both the most positive and most negative underperform on a monthly basis, and then for a quarterly basis, they both underperform as well. So from the total ESG score having a discernible pattern, a signal, and the E and the S scores having no discernible pattern, you can glean that the governance score is where a lot of this is being driven. When you take the ESG score and you hone it in on only governance issues, you can see that significantly more companies have news on governance issues. So they seem to be covered a bit more. And then also there's a bit more discernible of a pattern, especially on a quarterly basis, where the most positive governance companies outperform the market and the most negative governance companies tend to underperform as well. So the conclusions that we can glean here, first of all, the total ESG score has the most positive companies will outperform and the most negative companies will underperform in the same moment, in the same period when this news is coming out. In the next period, in the next quarter specifically, these companies that are the more negative in the previous quarter will tend to bounce back. The more positive companies will also seem to revert to their mean. But then when we break this down to specifically E, S, and G issues, we see that this signal is pretty much entirely coming from all of our governance taxonomy, our governance issues. This is not to say that environmental and social issues are not important for trading, but more to say that perhaps that the approach that we took looking at weekly, monthly, and quarterly scores does not capture the impact that environmental and social issues have. This kind of follows when you think about how long it takes to invest in clean technology, wind turbines, electric vehicles, invest in diversity and inclusion. These things don't lead to instantaneous impact. If you're going to see any benefit from these types of investments, which would be more positive on our ESG taxonomy, it'll probably take a few years. So another project that we could engage in the future would involve maybe taking longer term looks at what happens for the more positive E and S companies. Additionally, we only took this quintiling approach that was documented in a lot of the previous methodologies that we had looked at and researched for this project, but there are other different trading strategies that we could look into in order to maximize alpha. So that could be another potential expansion of the project. And with that, I'll pass it to Sam, who has any of the questions that have come in.
All right, thank you, Tom. Yeah, we have a few questions coming in from our viewers. I think this first one would be good for Doug. Why is it important to look at news in addition to the quarterly earnings calls? What does news give us?
Well, thanks for the question. The issue that a lot of people have with ESG news that's currently available is there's a lot of gap between the quarterly or annual reports in ESG news. So we can cover the interim reports as well, but the gap that news closes the gap. So we released our Amenity transcripts ESG news data set, and clients wanted to close the gap in the interim period. So 4 years ago, we released the ESG news data set, and really what it does for clients is it closes the gap and also confirms the firm's narrative in prepared transcripts, and even the Q&A session can be the wild card in prepared remarks. But the news can either validate what the company is saying about their ESG scores, or it can conflict. And in a couple of minutes, I'll kind of go over the intersect of those two data sets and the greenwashing and materiality scores that it helps us to produce in relatively real time.
All right, thank you, Doug. This next one is from Tom. from one of our viewers. It says, do you estimate alphas based on CAPM or FAMA French models?
Can you say it again?
Do we estimate the alphas for this methodology based on CAPM or FAMA French models, or in another way?
Oh, based on CAPM.
CAPM. All right. We have another one here asking about our news data. What is the source of our news data? We have over 8,000 news sources in our ESG data pipeline. These are both global and local in nature. And we also include some more trade journals, some more technical pieces to round out the analysis from just the mainstream media. One final question for Tom before we hand it back to Doug for our wrap up. Why do you think ESG metrics can be indicative of financial performance?
Issues can be indicative of financial performance in that they contribute to a company's reputational profile. For some of these bigger companies that will have scandals like Facebook, I mean, Facebook is Facebook. Unless they have enough of these scandals, I'm sure they'll still return pretty well. But for a company like PG&E that may not be in the forefront of the public discourse, having a series of scandals like they've had can lead to significant sell-offs as companies worry that PG&E is known as the company that caused all of these wildfires, for example. So for some companies, the reputational profile impact that these ESG issues can have will lead to long-term price dynamics. But for others, it will just be kind of this V effect where people panic and overreact to some of the news, but then remember that the company still has good underlying financials. So I guess the answer would be for some companies, this is a bit set, like that people worry about the financials being impacted by the reputational profile of the company. But for other companies, it's just a quick sell off and then regain to form, mean reversion.
Right. Yeah, it's this idea that nothing really happens in a vacuum, and just because spending or investing one way might not affect price in the short term, it doesn't mean a year down the line it's not going to be beneficial, or vice versa. Just because a company's doing something poorly now, it might not have any short-term impact until down the line. Thank you for that, Tom.
Yeah.
And without further ado, we'll hand it back to Doug for our wrap-up. Thank you.
I appreciate it. And I'm going to add a little bit to the question on news sources. So we have 27,000 global news sources available. We've curated it down to 8,000, but we've had some interesting requests. We've had requests to add local small town newspaper sources where corporations have plants or factories, because the feeling was that if something is going on with that company's plant or factory, it's going to emerge in the local news first. The other interesting thing about the IP between our ESG news data set is it's able to determine whether it's independent news or if it's company news. So for example, a press release would be included in the company narrative, not in the news data feed. It can also recognize, for example, if it's the CEO or CFO or somebody from the company speaking, it tries to recognize that as also the company's narrative. So really in the data set, we're really trying to capture the difference between the company's narrative and the media's narrative on that company. So great questions. A couple final thoughts here. We had some questions about greenwashing and materiality. So, we have two ESG news data sets. The paper, once again, the white paper that Tom wrote is available, and we can provide it to anybody who would like a copy of it. But ESG news grew out of our ESG transcripts data feed. And I think the important thing, about being able to capture the news on a company in the interim period between quarterly or annual reports has produced some interesting outputs. One of them is greenwashing. So as I said earlier, the company has a narrative in their transcript. That narrative could be upset a little bit in a wildcard in the Q&A session that we also cover in the data set. But is the company's narrative the same as the narrative in the media? And I think we score both, and then we produce a greenwashing score. If you're a company, you'd want that to be close to zero. And in our data, a zero means the narrative is aligned. If it starts to be a mismatch, we're producing a negative greenwashing score on that company. And basically that greenwashing score is updated daily. So it's more along the lines of real-time data. The other thing is we use both data sets in our materiality. So we do what commitments the firm has made, both through their filings and transcripts and any press releases. And then we track actually the numerical investments that they've made commitments for. And then we do milestones as well. So have those commitments been achieved? So in using the different data sets, we can really produce some interesting metrics. And you know, these two ESG data sets are just part of a suite of data sets that we have as well. You know, and this page lists some of those other data sets that we do as well. So, you know, I want to thank Tom and Sam for a great presentation today. I want to thank everybody for joining. If anybody has any further questions, please don't hesitate to reach out to us. And we just want to thank everybody for joining today. We appreciate it.
Thank you.
All right, thanks.
Thanks, everyone.
Bye-bye.